Drake gets approved for a mortgage, sees one single monthly payment number he can comfortably afford, and signs the paperwork without asking a single follow-up question. 18 months later, he's quietly cutting his grocery budget every single month just to keep the house afloat, and he still doesn't fully understand why that's happening. Because the one number printed on his original paperwork never actually changed at all since the day he signed it. The number sitting right there on the paperwork was genuinely never the real, complete cost of owning that home. It was always just one piece of it, and the remaining pieces nobody bothers to point out clearly at the closing table are exactly what quietly turn a perfectly affordable-looking mortgage into a real financial trap over time. Quick one before we break this down. If breaking down the real cost behind the advertised number is useful, hit subscribe, new video every week. Before going further, it's worth being clear about what this video is and isn't. It's not an argument against buying a home at all. It's an argument against buying one using only the number a lender happens to show first. The math changes the decision's comfort level, not its underlying wisdom. When most people say mortgage payment, they mean principal and interest. The amount that pays down the loan balance and covers the lender's interest charge. As of the most recent NAR data, the median U.S. home sold for $417,800 in April 2026, with 30-year fixed mortgage rates running somewhere between 6.5% and 7.5% through this period. But a mortgage payment in practice usually bundles more than just principal and interest. Property taxes and homeowners insurance typically get added directly into the monthly bill through an escrow account. And two more real costs sit entirely outside that bill, never appearing on the mortgage statement at all: private mortgage insurance, if it applies, and home maintenance, which nobody bills monthly but which shows up eventually regardless. Here's Drake's actual math, using the current median home price and an illustrative 7% rate, right in the middle of today's confirmed range. He puts 5% down, $20,890, leaving a loan of $396,910. His principal and interest payment alone comes out to $2,641 a month. That's the number his lender showed him. That's the number he budgeted around. Against his actual take-home income, $2,641 looked completely reasonable and comfortably manageable at the time he signed. It's also, as it genuinely turns out once every other cost gets added in, only about 2/3 of what the specific house actually ends up costing him every single month going forward. Property taxes average 1% of a home's value per year nationally, though the exact rate varies significantly by state. On Drake's $417,800 home, that works out to roughly $4,596 a year, $383 a month, added directly onto his mortgage bill through escrow. Homeowners insurance separately runs $1,700 to $2,100 a year nationally on average, and using that midpoint. That's another roughly $158 added every single month. Add both of those two extra costs together, and Drake's genuinely real monthly bill is already $2,641 plus $383 plus $158, coming to $3,182 total, not the original $2,641 he had actually budgeted for. And all of this is still before we even get to the part that genuinely surprises most first-time homebuyers the most. Because Drake put down less than 20%, his lender requires private mortgage insurance, PME, which protects the lender, not Drake, in case he defaults. PME runs 0.5 to 1.5% of the loan amount annually on a conventional loan. Using an illustrative 1% rate on his $396,910 loan, that's roughly $3,969 a year, $331 a month, on top of everything already added. Add that in, and Drake's real monthly mortgage bill, what's actually called BT in the industry, principal, interest, taxes, and insurance, plus his PME on top, comes to $3,513. That's $872 more than the $2,641 number he originally signed up expecting to pay. None of what's been covered so far includes the cost that arrives the least predictably but the most expensively: maintenance and repairs. The standard guidance is to budget 1 to 2% of a home's value annually for this. On Drake's $417,800 home, that's $4,178 to $8,356 a year. Using the midpoint, roughly $522 a month. Even though it won't actually arrive as a smooth monthly bill, it shows up as a $6,000 roof repair or a $2,000 water heater replacement instead. The 1.1% national average property tax figure used in this video is exactly that, a national average. The real range by state is dramatic. New Jersey homeowners pay an effective rate of about 11%, roughly $7,022 a year on a home valued around $332,700. Hawaii homeowners on the same value home pay an effective rate of just 0.27%, about $888 a year, nearly 8 times less. This is exactly why check your specific local rate matters more than memorizing the national average. The difference between living in a high-tax state and a low-tax one can be worth several $100s a month on its own, independent of everything else covered in this video. Add that in, and Drake's genuinely complete monthly cost of owning this home comes to $4,035. His PT of $3,513 plus a $522 maintenance reserve. That's $1,394 more per month than the $2,641 figure he originally budgeted his entire lifestyle around. Daniel bought a comparable home, but waited longer to save a full 20% down payment, $83,560, leaving a smaller loan of $334,240. His principal and interest payment, $2,224 a month, meaningfully lower than Drake's, purely because he's borrowing less. Add the same $383 in taxes and $158 in insurance, and Daniel's PT comes to $2,765. Critically, there's no PMI line at all. A 20% down payment means the lender doesn't require it. Add the same $522 maintenance reserve, and Daniel's genuinely complete monthly cost is $3,287. Same home price, same interest rate, same tax rate. The entire $748 a month gap between the two of them, month after month, comes down to a single decision made well before either of them ever signed anything at all: how much actual cash went in upfront. None of this makes Drake's 5% down payment an automatic mistake. Either putting less down keeps more cash available for an emergency fund or other goals, and for some buyers, getting into a home sooner, even with PMI attached, outweighs the extra monthly cost. The actual mistake wasn't the down payment size, it was not knowing what that choice would cost him every month before he made it. Before any of the monthly numbers even start, there's a separate upfront cost, closing costs, which typically run 2 to 5% of the loan amount, due either in cash upfront or rolled directly into the loan itself. On Drake's $396,910 loan, that's $7,938 to $19,846. On Daniel's smaller $334,240 loan, it's $6,685 to $16,712. One more way a smaller loan quietly costs less across the board, not just in the monthly payment. Combined with his down payment, Drake's total cash needed at closing was somewhere between $828 and $40,736, not just the $20,890 down payment figure that was likely the number he was mentally budgeting toward. A lender's pre-approval letter really only tells you the absolute maximum amount they're willing to lend you, based largely and specifically on your income and your existing debt obligations. It says essentially nothing about the actual property taxes in your specific target area, your own specific insurance quote, or what your particular home will genuinely need in repairs over time. Treating a pre-approval amount as the target price rather than a ceiling is exactly how someone ends up in Drake's position. A commonly used guideline, the 2836 rule, offers a sturdier target. Total housing costs, the full PT, not just principal and interest, should generally stay under 28% of gross monthly income, and all debt combined, including the mortgage, under 36%. Many lenders will actually approve buyers well above these thresholds, up to a 45% total debt to income ratio on conventional loans, which is exactly why the lender's number and the genuinely comfortable number are often two very different figures. It helps to see the 28-36 rule applied to an actual number, not just as an abstract percentage. Say a household brings in $9,000 a month before taxes. The 28% housing guideline caps a comfortable PT at $2,520, noticeably below Drake's actual $3,513 PT, even before his separate maintenance reserve is added on top. On paper, a lender might still approve Drake at that income level, especially with light other debt, but he'd already be well outside the guideline built specifically to keep housing costs comfortable rather than merely approvable. The 36% overall figure works the same way. On that same $9,000 income, total monthly debt, mortgage included, should stay under $3,240. Add a $400 car payment and $200 in student loan payments to Drake's $3,513 PT, and his total debt load reaches $4,113, well past the guideline, even though a lender's own maximum approval threshold might still technically clear him. If this is already describing your own mortgage, it isn't a permanent state. PME specifically is removable, not lifelong. Once a loan balance drops to 80% of the home's original value through regular payments, extra principal payments, or the home's value simply rising, a homeowner can typically request PME be canceled, dropping that cost entirely without refinancing anything. Extra principal payments, even modest ones, accelerate that timeline directly and refinancing into a lower rate. If rates have genuinely dropped since the original loan, can shrink the principal and interest piece too. None of this happens automatically. It requires the homeowner to actually track their loan-to-value ratio and request the change themselves. This is genuinely what the phrase house poor actually looks like in real, everyday practice, not some dramatic, sudden financial collapse at all. But instead a slow, quiet, months-long squeeze applied steadily to every single other category of an otherwise reasonable household budget. Because the true housing cost ended up $1,394 higher than the number that got budgeted around in the first place. Groceries get trimmed, subscriptions get canceled, a needed car repair gets delayed. None of it shows up on the mortgage statement, but all of it traces back to the same original gap. Daniel's entire version of this same story doesn't actually require any more discipline or a meaningfully bigger income than Drake had access to. It simply requires the exact same information, used deliberately before signing anything instead of being discovered painfully after the fact. The $748 a month difference between the two of them was entirely visible in advance. It just required asking about PMI, taxes, insurance, and maintenance before the offer, not after moving in. It's worth naming why Drake skipped this math in the first place, since it wasn't carelessness. Buying a home is an emotional decision as much as a financial one. By the time a buyer has toured a house, pictured their life in it, and started imagining furniture placement, the mortgage payment on the pre-approval letter starts to feel like a formality to get past, not a number worth interrogating further. Daniel's advantage wasn't more financial knowledge, it was sequencing. He ran the full pity plus maintenance math before touring anything seriously. While the numbers were still abstract and easy to think clearly about, instead of after falling in love with a specific kitchen and a specific backyard. Concretely, before making an offer on any home, 5 questions are worth answering with real numbers, not estimates. What's the actual property tax rate in this specific county, not the national average? What will insurance actually quote for this specific property? Does the down payment clear 20%? And if not, what does PME add? What does 1 to 2% of this home's value look like as an annual maintenance reserve? And does the full total, pity plus maintenance, fit inside 28% of gross monthly income, not just inside whatever the lender approved? Every one of these numbers is knowable before an offer goes in, not after. The entire gap this video has been describing exists specifically in the space between knowable and actually checked. The advertised mortgage payment is principal and interest only. The real monthly cost adds property taxes, averaging 1.1% of home value, homeowner's insurance, $1,700 to $2,100 a year, PMI, 0.5 to 1.5% of the loan if under 20% down, and a maintenance reserve of 1 to 2% of home value. On a median-priced home, that gap ran $394 a month in this video's example, and a bigger down payment alone closed $748 of it. The real trap here was genuinely never the mortgage itself as a financial product. It's the habit of budgeting carefully around the single number printed on the paperwork, instead of the full, complete number that actually and quietly leaves your bank account every single month once every real cost is properly counted. This video is for educational purposes only and is not personalized financial advice. If this genuinely changed how you'd approach budgeting for a house in the future, go ahead and subscribe. New video every single week. Next time on the channel, whether your own early retirement number is actually as safe as it might currently look on paper.